Current live trading for Navitas Semiconductor Corp., ticker symbol NVTS, is showing the stock changing hands at roughly $7.77, currently navigating a volatile intraday session where buyers are desperately trying to establish a floor. We are seeing the price hovering in this 770 to 780 range, attempting to stabilize after what has been a punishing few weeks for the semiconductor sector. The stock is down significantly from its recent highs, but in today's session, we are witnessing a fascinating battle at this support level, with volume ticking up as the morning session in New York progresses. This isn't just a number on a screen. This is the market deciding in real time whether this company is a falling knife or a coiled spring waiting for the next leg of the semiconductor supercycle. Most investors looking at Navitas right now see a disaster. They look at the chart, they see the recent earnings report where revenue seemed to vanish, and they see a small-cap chip stock getting crushed under the weight of interest rates and sector rotation. That is the expectation, a struggling company with a broken thesis. But the reality, the deep, uncomfortable reality that the algorithm trading bots and the smart money are currently chewing on is that Navitas isn't failing. It is undergoing a radical, intentional, and highly risky metamorphosis. You are not looking at a company that simply missed earnings. You are looking at a management team that effectively decided to burn down their old business model to build a new one that caters exclusively to the most insatiable hunger in the modern world, the power needs of artificial intelligence. The market is pricing in failure, but if you look at the physics of what they are building, the reality might be that we are standing at the ground floor of the next great infrastructure play. Let's talk about what is actually happening on the tape today. The price action we are seeing right now, oscillating around this $7.77 mark, tells a story of capitulation and accumulation happening simultaneously. Retail traders, perhaps using the Robinhood app or glancing at their SoFi Invest dashboards, are seeing the red percentages from the last week and are hitting the eject button. They see revenue down 53% in the headlines, and they run. That is natural human psychology, flight from danger. But if you dig into the order flow, if you look at the block trades potentially executing through dark pools or via major desks like Interactive Brokers, you might see a different story. You see absorption. Why would anyone be buying a stock that just reported a massive revenue drop? Because the drop was engineered. Navitas explicitly stated they are walking away from low-margin business, cheap mobile chargers, commodity consumer electronics, to focus entirely on high-voltage, high-margin power for data centers and electric vehicles. This intraday fighting we are watching is the friction between the backward-looking investors who see the revenue drop and the forward-looking capital that sees the margin expansion. To understand why this matters, we have to step back and look at the broader market context. Right now, if you own NVIDIA stock, your biggest concern isn't whether they can sell chips, it is whether the world has enough electricity to run them. Data centers are becoming dangerously power-hungry. The current silicon-based power infrastructure is inefficient. It generates too much heat and wastes too much energy. This is where Navitas enters the conversation. They don't make the brains of the AI, they make the heart and lungs. They produce gallium nitride, or GaN, and silicon carbide, or SiC, power chips. These aren't just buzzwords, they are chemically superior materials to silicon. They handle higher voltages, switch faster, and, most importantly, run cooler. When you see Tesla stock fluctuating based on EV adoption rates, you have to remember that the limiting factor for EVs is often range and charging speed. Navitas's technology is the key to unlocking faster charging and longer range without making the battery bigger. The market knows this, which is why, despite the ugly earnings print, the stock hasn't gone to zero. It is hovering here because the technology is inevitable, even if the company's current financials are messy. Let's get granular on the recent movement. The stock has shed significant value since the Q3 report earlier this month. We saw a gap down that flushed out a lot of weak hands, But look at the volume on that flush. It was massive. High volume on a down move usually indicates panic, but when the stock stops going down on high volume, which is what we are trying to confirm in today's session, it often means that the shares are moving from weak hands to strong hands. It's the classic transfer of wealth. Investors using the Schwab Intelligent Portfolios or checking their Fidelity accounts might notice that the semiconductor sector as a whole has been under pressure, with major players like Wolfspeed also facing existential questions. But unlike Wolfspeed, which is grappling with massive capital expenditure issues and debt, Navitas has a relatively cleaner balance sheet, with nearly $100 million in cash. This gives them a runway. The market is currently asking, is the runway long enough? The narrative tension here is palpable. The Navitas 2.0 strategy is a high-stakes gamble. By cutting 14% of their workforce and exiting the mobile market in China, they are betting everything on the West, on US and European data centers and the EV market. This is why the comparison to Apple stock is interesting. Apple controls its supply chain masterfully. Navitas is trying to position itself as a critical, irreplaceable component in the supply chains of the companies that will define the next decade. They are not trying to be everything to everyone anymore. They are trying to be the singular solution for high-density power. If they succeed, the current price of $7 and change will look like a historical anomaly. If they fail to capture the data center market before their cash runs out, the skeptics will be proven right. I want you to take a second and think about your own portfolio. Comment below how many shares of Navitas you currently hold, or if you are waiting for the price to drop further before starting a position. Are you buying the fear, or are you selling the news? It is always interesting to see where the community sentiment lies when a stock is this beaten down. Now let's analyze the technicals without getting too bogged down in the weeds. We're sitting below the 50-day and 200-day moving averages. In traditional online investing theory, this is a bearish signal. It means the trend is down. But contrarians love this setup. When a stock is this far extended to the downside, the rubber band effect can be powerful. The RSI, or the Relative Strength Index, has been flirting with oversold territory for days. For those of you who invest online using technical indicators, you know that an RSI below 30 is often a signal to start watching for a reversal. Navitas has been hammered so hard that it's screaming oversold on almost every time frame. This doesn't mean it has to bounce today, but it means the selling pressure is likely nearing exhaustion. The shorts, those betting against the stock, are sitting on massive profits right now. At some point, they have to buy the stock back to cover those profits. When they do, that buying pressure, combined with any positive catalyst, could ignite a short squeeze that rips the stock higher in a matter of days. We also need to discuss the institutional landscape. When you look at holdings from giants like Fidelity Investments or the flows into Fidelity ETFs that track semiconductors, you see that these funds cannot easily liquidate their positions in small-cap stocks without crashing the price. They are often stuck holding the bag during downturns, but they also have the capital to average down. If you see Fidelity brokerage accounts showing accumulation in this name, it is a sign that the long-term thesis remains intact for the big players. They are looking at 2027 and 2030, not next quarter's earnings. They are looking at the forecasts that say the GaN market will triple or quadruple in size. They know that silicon has reached its physical limit. It cannot physically handle the power density required by the next generation of NVIDIA Blackwell chips without melting or requiring absurd cooling solutions. GaN is the answer. However, we must address the risks. We are talking about a company that is losing money. The Q3 loss from operations was significant. They are burning cash to fund R&D and to keep the lights on while they wait for the Navitas 2.0 revenue to kick in. This is the classic valley of the death for a growth company. They have left the safety of their old business model and are trekking across the desert to reach the promised land of data centers and EVs. They have water in their canteen, but they cannot wander forever. This is why the Interactive Brokers trading desks are pricing in such high volatility. The options market is implying massive moves because the outcome is binary. If they win the data center designs and the stock goes to $20, $30, or $40, or they don't and they face a liquidity crisis. Let's pivot to the competitive landscape because Navitas does not operate in a vacuum. You have Infineon, the German giant, which is both a competitor and, interestingly, a partner in some dual sourcing agreements. You have onsemi, you have Wolfspeed, but Navitas is unique because it's a pure play. It doesn't have a legacy silicon business to protect. This